Today we have ultra low interest rates. This forces investors to look for assets which have some level of return. With this comes added risk. So-called riskless assets have lower negative rates, which has caused a greater appetite for risk taking. As these investors pile further and further into riskier assets and as more leverage is used, the fragility of the system will be exposed and will end horribly for those stretching themselves beyond their means. You came here for the truth, so let me unveil that for you. Today we're going to look at what's happening in the financial system. We are going to talk about interest rates. We're going to talk about the central banks. We're going to look at what is happening right now, and I believe that these are some ominous signs. Let's get into it right away. Here you can see the S&P 500, that's the light green line, and you can compare that with the global money supply, and they are in lockstep. This has been the case for many years, of course, ever since the central banks around the world, particularly the Federal Reserve, had decided to go into this quantitative easing mode. This has been the case, where the US stock market, but even less directly, you can see the global stock market, has basically moved along with the central bank balance sheets. The more money they print, the higher it can go. When this actually changed for a very short period of time, 2018, we saw a very mild contraction in the global central bank balance sheets, and 2018 was the first year since the financial crisis that we actually saw negative returns. In fact, 93% of assets were down in this period of time. Now, that was 1 year out of this whole bull market. Many people ignore 2018, but it is a very important sign that people need to pay attention to, that the global central bank balance sheets are directly linked with not just the stocks that you own, not just what investors own, but the pension funds, the 401ks, and everything that's interconnected. Here we are looking at the LIBOR rate. Now, while they're suggesting that in a few years we're going to see this go away, for the time being, over $200 trillion worth of assets around the world are using the LIBOR rate to trade on a daily basis. This is very important. People should pay attention to it. And of course, we can see historically how this has been. You could look at this through the previous cycle and see what happened. We had the same exact method that you will see with the Fed funds rate, though the percentages vary. Here we had about 5%, 5.5% during the last cycle where they able to basically get it to that point from 2007, let's say, and then they had to bring it down to the lowest levels we have ever seen. Now today, they are beginning the same thing again. We are watching as interest rates decline, not just with the Federal Reserve, but of course this goes with all of those around the world, whether it's something like the LIBOR or whether it's the ECB or what have you. We are starting this contraction phase. We are starting the exact same thing that happened in the previous cycle. And you could see in this case with the LIBOR, as soon as they had to bring that down, the recession was imminent. Now, that could necessarily be a different story this time around, but I just wanted to point that out. As you see the central banks around the world going towards easy money, that tends to be when a recession hits. We're not there yet, according to their statistics, but I just wanted to show you it because, of course, these are part of the ominous signs. Junk Bond Fund draws $622 million as negative yields go global. If you look around the world, one of the most common things is negative yield. We have over $13 trillion worth of negative yield, and this goes for even the junk bonds. That's how crazy things have become today. Now, in this case, they're talking about this high yield corporate bond. It extends through governments as well. We're seeing the corporations, all of their debt is now becoming actually an investment that gives you a negative yield. And it's really hard to wrap my head around sometimes, and I know I see the comments all the time too. People are asking, is this really the case where I'm going to put my money in and I'm guaranteed to lose money on the way out? That's a fact. You are going to put your money in and you're going to take out less. Don't worry about inflation. Don't worry about actually trying to make a profit. What you're trying to do is hope that that company or that country stays solvent. Isn't this crazy? crazy? Isn't this insane? Shouldn't there be some sort of conservative nature from investors at this point, suggesting that what we have seen right now is not a good sign for the health of the actual economy and the markets themselves? No, risk taking always gets to its maximum right at the peak and even beyond, because people see it as an opportunity, so they rush into it, and that actually creates an even worse problem in that near term. Here we have the debt to GDP for Greece. That's 182%, the red line you're seeing. And the green line is the 10-year Greek bond. Now, you can see what had happened when they had the sovereign debt crisis. This had spiked up. You were getting incredible returns. Now today, you are getting basically nothing. It's the lowest it has ever been. So the value of this, despite the fact, in my opinion, this is a very risky investment to take on. We don't know what's going to happen with Greece. Are they going to default? Are they going to be able to pay their bills? Nobody really knows. But in this case here, you are getting less than 2%. That to me tells us that something is wrong right now. Not with Greece, not with the EU, but with the financial system itself. This is a comparison between the 10-year for the US and the 10-year for Greece. You actually get a slightly better return on the US debt. Now, why do you think people have been piling into US debt? Simply because you have fantastic returns when you look at its peers. Do you want to take a negative yielding bond for some of these countries out there? Or are you simply going to take what they call riskless assets and purchase some of that US debt? We are watching something crazy going on in the financial system today. I am surprised that it has been able to sustain itself. One of the biggest problems here with all of this negative yielding debt, with interest rates being so low, and the insanity that we have seen since 2009, is that these banks, these financial institutions, are getting hurt by all of this. Now, we don't necessarily need to worry about the financial institutions and breaking their hearts. What we do have to worry about is how this affects the wider system, because once the financial companies get hurt, they start laying people off. Look at Deutsche Bank, look at now Unicredit and others that I have talked about on the channel. This is the stocks banks. We're looking at the European financial companies that had been absolutely beaten down throughout this period. They are nowhere near where they were before the financial crisis, and in fact, they are consistently heading lower. Even if you exclude the peak that was there in the 2000s, it really just looks like these are actually getting worse and worse, simply because of all of the factors, including lower and lower interest rates over the years. The IMF right now, they are sending out the warning signals, which they have done many times before. In this case here, global trade tensions, continued uncertainty, and rising prospects for a no-deal Brexit are sapping the strength of the world economy, which faces a precarious 2020. So they are not saying anything about 2019. They are making it very clear that 2020 is the year when things could get heated up. For now, everything seems to be fine according to the IMF. There are simply some dangers present within the system. I just wanted to show you that they reduced their outlook for next year, suggesting that there are some headwinds and so on. Really quickly wanted to look through the PMIs. This comes out of market economics, something I show you very regularly here on the channel. Stronger service sector growth helps offset manufacturing downturn in July. So we have this slight glimmer of positivity here among all of the contractions and negativity. What we're looking at here in this case, the US Composite Output Index is at a 3-month high. We're looking at the Services Business Activity Index, that's also at a 3-month high. But then when you look at the manufacturing PMI, is at a 118-month low, as well as the manufacturing output index at a 119-month low. If you look at the chart there in the bottom left corner, it just shows you that there is a contraction that is going on right now. This is comparing the manufacturing PMI, the services PMI, and although we have been trending down since last year, in the short term, this has actually come up in terms of services. It continues to fall for the manufacturing PMI. This is the PMI data here on this chart for different countries. You can see the green line, that's the US. You're looking at the Eurozone, which is the dark red line. The Japanese is in blue, as well as China in the brighter red color. And that just shows you that we have seen this weakness going through 2018 right into 2019 for the most part. And it has been a serious fundamental issue that is not really dealt with quantitative easing. It's not going to fix the problem. Germany and France, both of their PMIs continue to fall. This has been happening basically since the beginning of 2018 and continues till today. Just wanted to finish off with this right here. This is James Rickards, or Jim Rickards, and he had something to say about what all of this computer trading algorithm has been built up to and what will result here in the near future. Basically suggesting right now that 80% of the trades that take place are done so with computer algorithms. When you look into it deeper, it is actually known that 95% of the activity is without human involvement. So this is a big danger, not necessarily when they're buying, but of course when they're selling. This is a topic I talk about all of the time. I talk about the high frequency trading, I talk about the computer algorithms, and James Rickards was bringing it up and essentially saying that when everybody starts to sell, it's going to be panic, it's going to be chaos. In the third paragraph, stocks will go straight down with no bid. The market crash will be like a runaway train with no brakes. This is something I get into all the time, and for good reason. This is going to be a problem in the near future. There is no doubt about it. That's all for this video. If you found it informative, please hit that thumbs up button. Hit that like button if you want to support this channel. I do appreciate that very much. If you want the financial education you were not taught in school, these two books have everything you need from top to bottom, A to Z. You can get all the details at the link in the description. If you want the audiobook, that's available at themoneygps.com. Did you know that the Federal Reserve bailed out banks all around the world to the tune of $16.1 trillion? If not, if you want to know the details, then definitely watch this video, click on it, and I will see you there.